Alright, we're now looking at the balance sheet. We're now looking at the balance sheet class, right? So the balance sheet, what we have been exposed to, remember when we did depreciation, right? We're already exposed to the non-current aspect of it, right? Where you have your at cost, the second column your accumulated depreciation, and the third column you have your net book value. Alright, so first off which there, we're going to list the assets in the order of permanence, right? Meaning that the asset that are ordered to convert to cash will be listed first. We discussed this in our earlier lessons. So you have building. So you put building at cost, right? Premises at cost, equipment at cost, motor vehicle at cost, providing that these were the only fixed asset that we have, or non-current asset that we had. The second column would have put in our accumulated depreciation. When we minus it from our at cost, we get our what? Our net book value, right? So you'll have the total of all of those columns there for the year 2002. Next, we move into our current asset aspect. Now, the current asset aspect, we start with our what? Inventory. Which of the inventory we're talking about? The closing inventory, right? Your closing stock. We're talking about the closing inventory, your closing stock. That is what goes there. Not the opening stock, but the closing stock. Then below we have our what? Debtors. Now, when we have our debtors, then what do? We minus the what? You see here, subtract PFBD. That is your what? You subtract your provision for bad debts. This is in the provision for bad debts lecture video. Right? You minus your provision for bad debts from your debtors. Because remember what you're trying to figure out realistically how much you're going to collect for that year. So even though 100,000 might be owed to you, but when you had set a provision for 5% of 100,000 is what? 5,000. So in the minus of 5,000 from the 100,000, you'd have got what? 95,000. So what you're saying, realistically, you'd collect 95,000 within the year 2002. Because you had set a provision for 5,000 there, right? Now below you have your prepaid expense. Now I haven't done prepayment and accruals with you as yet, right? However, you can read up on it, but I'm going to explain it here and now, and then I'm going to do another lecture video as it relates to it. Now prepaid expense. Now remember, what are expense? Expense are what you owed, right? Now we have prepaid expense as a what? Current asset, meaning that it is yours. Why is that so? Now assuming that you owe JPS $10,000, right? Assuming that you owe JPS $10,000 for the month of April, right? Now when you go to JPS, you pay them a total of $11,000. If you pay them a total of $11,000, it means that you would have what? Prepaid on an expense. You would have paid in advance what? $1,000. So prepayment mean what? Money paid in advance. Now because it was an expense to you, right? You would have overpaid $1,000. So you would have prepaid on the expense. So you'd have prepaid $1,000. So that $1,000 is your money. So that is why it is listed under your current asset, because it is your money, JPS owes you. So it becomes an asset to you and not a liability. On the flip, below you have what? Accrued revenue. You have what is known as accrued revenue. Now what are revenues? Money that you expect to collect, right? Money that you expect to collect, right? Revenues is money that you expect to collect, right? Now, accrued revenue, right? The word accruals there meaning owing. The word accruals there meaning, the word accrued comes from the word accruals, right? It goes back to your accruals concept. If you go back and look at that concept, the accruals concept. Revenues and expenditures are recorded in the period in which they occur, irrespective if they were paid or not. So if you go back to that concept. Now the word accrued there mean owing, come from the word accruals, right? So accrued revenue make reference to, take for example, rent received. Rent received would have been a revenue. If your tenant is supposed to pay you $10,000 for the month, it so happened that they were facing financial difficulty, right? COVID-19 are coming. Well, COVID-19 is here, right? So they owe you $10,000. Right, they called you as the landlord and said, listen, listener, I only can come up with $8,000 for this month, right? Just give me another 2 weeks and I'll pay you the additional $2,000. Right? It simply means that you should have collected what? You should have collected what? 10,000, right? But they only had what? 8,000 to give to you. So therefore that accrued revenue, meaning that money that is expected from your tenant, right? That accrued revenue would have been included there of that 2,000. It's an what? It's an asset to you because it's money that you're expected to collect. It's money that the company is supposed to collect in the future. So you have accrued revenue listed there also. Right? Accrued revenue listed there. Then you put in your bank balance, meaning that the money that you have at the bank. Then you put in your cash balance. Then what you do, you add up all of your current asset, and to the right you put the total. So to the right of which you would put the total, right? So you put the total, what the total of your current asset equal to. Now below, you move into your what? Current liability. Now your current liability, remember you know what current liabilities are. Liabilities that become owing for a period less than a year. So your current liability, right? Your current liability is there. Alright? So we have our current liability. So now we're going to list our current liability. Now in our current liability we have our what? First of which we have our what? Our creditors. Right? So we have the creditors. Right? Followed by bank overdraft. Now mind you, you would not have a bank balance. You would not have a bank balance in the current asset and also a bank balance in your current liability at the same time. Right? You will not have that happening. Right? Unless there are two different bank accounts. So what we are saying here is that if the bank balance, if the money in the bank is your money, it would have been on your what? Current asset, because an asset to you. However, if that figure is if that bank balance is that it's the bank balance that is owing, meaning that if you look in the trial balance and you realize that the bank balance that they give to you is on the credit side, it simply means that it's a what? Liability. If the bank balance was on the debit side in your trial balance, it therefore means it's an asset. It is your money. But if it's on the credit side, if the bank balance is on the credit side, it therefore means it's a bank overdraft. Right? If it's a bank overdraft, then it would appear under your what? Current liability. Right? So you would have had creditors followed by your bank overdraft. So if there's a bank overdraft appearing there. Next we had what? Prepaid revenue. Now remember we spoke about revenue earlier, right? And we use the example of rent received. So we're saying that the tenant is supposed to pay you $10,000. And right? We spoke about that earlier. And the tenant would have paid you less. Now the situation here, or the scenario here, is that the tenant also is supposed to pay you $10,000. But what if the tenant had paid you $12,000? It therefore means that the tenant would have paid you what? More. The tenant would have paid you more than what they owe to you. So the fact that the tenant would have paid you more than what they owe to you, right? The fact that the tenant would have paid you more than what they owe to you. So if the tenant owe you $10,000, it's supposed to pay you $10,000 for rent, but they paid you $12,000 this month. You, which is operating the business, right? So you that is operating the business would have now what? Owe the tenant. You would have owed your tenant what? $2,000, because they would have paid $2,000 in advance. So you would have owed the tenant $2,000. So if the tenant decided that they're not going to be there for next month, you will be liable, and it's a liability for you. So you'd have to pay back that tenant that $2,000 that they would have overpaid you. So that is why you have prepaid revenue appearing under your current liability. Right? So that is why you have prepaid revenue listed under your current liability. Next you have what? Accrued expense. Now remember what accrued means. Anything that you what? You owe. Now this represents a what? It said accrued expense, so therefore it's an expense that is what? Owing. So again, your JPS bill come to $10,000. But if you go by JPS and you only pay them $9,800, the business still owe JPS what? $200. Right? So again, if your JPS bill come to $10,000, but you go by JPS and you had only pay them $9,800, you're still owing them what? $200, right? So therefore, accrued expense there would have been a liability, and that is where you would find that $200 been listed, showing that you still owe. At the end, you have a current liability of $200, right? Which is owing to JPS, or it could have been on any other expense. Now from there, you're going to you're going to add up all of your current liabilities. So therefore, you're going to add up your creditors. You're going to add your creditors to your bank overdraft, to your prepaid revenue, to your prepaid expense. And also tax. If there was any tax there, taxes would have been under your current liability, right? So you're going to add up your current liability. Now when you add up your current liability, you're now going to what? Minus it from your current asset. So you're going to minus the total. So you add up your current liability and you put the total to your right. Now you see that, and you see we put that in bracket right there, right? You've got to subtract it from the figure above. What is that figure above? The figure above represents the total of your current asset. Right? It represents the total of your current asset. Now when you minus it from the figure above, now say for example the total of your current asset was say 100,000. And the total of your current asset and the total of your current liability is, let us say, $30,000. Right? So current asset, total of your current asset 100,000, total of your current liability 30,000. When you minus the 30,000 from the 100,000, you're going to get that figure now going to your far right, which we have in circle, which we put circle right there. So the 30 minus the 70, the 30 minus the 100, sorry, would have given us what? 70,000. Right? Would have given us 70,000. And that is what we call our what? Working capital. So that figure there that you see with circle is what is called your working capital. So if ever you're asked, what is your working capital? Your working capital is when you minus the total of your current liability from the total of your current asset. It gives you your working capital. Now that working capital figure, you're going to add it to the total of your non-current asset, or in other words, you're going to add it to the total of your fixed asset, right? So so that is that figure that you have above, right? So when you add up the total of your net book value, right, you're going to add your working capital to it. And when you add your working capital to it, you get that figure below that you see with double line, which is known as your total asset. Right? So that figure below that is known as your total asset. Right? So you add your working capital to the total of your net book value, which is immediately above, and you get a total right there, which is called your total asset. So if the total of your net book value was, say, 200,000, when you add your working capital of 70,000, you're going to get below right there 270,000. All right. Now next we're going to move over. We'll continue by looking at our what? Finance buy. Continue by looking at our finance buy, right? And the finance buy, we started out with our what? Capital. Capital, otherwise known as the what? Equity. So you have the word equity there in bracket, right? So that figure there in bracket that you can hardly see, it is known as equity. Remember, another name for capital is what? Equity. So you have your capital, which is otherwise known as your equity. Then we do what? We add our net profit. Where is that net profit coming from? It is coming from the income statement, right? So that last figure that you would have had in the income statement, that is the figure you're going to carry over to your finance buy and add it to your capital, right? You add it to your capital. Now, below, you're going to do what? After you would have added it to your capital, so whatever your capital was, if your capital was, say, 500,000, you add your net profit, which is coming from your income statement, then you would have got a total. Then you're going to what? Minus your joins. So any joins, meaning that anything, and remember that joins are what? What the owner would have taken out of the business, right? So you'd have find also the joins in your trial balance. You've got to subtract that joins, right? You've got to minus that joins, right? Then you've got to minus that joins, and then you'll get a figure there that you have below. You get a figure that you have there below, right? Now, that figure would equal to your total asset if there was a case that there were no long-term liability. So if there were no long-term liability, right, that fit when you minus your joins, there you'd get the same figure that is your that you would have got for your total asset. But if there's long-term liability, you'd have to add those long-term liability. Right? So long-term liability, right? So long-term liability could be like your mortgage, your loan, right? Remember that long-term liabilities are liabilities that become owing for a period greater than a year. Right? So they are known as long-term liabilities. So if there were any long-term liability, right, you're going to add those long-term liability to that figure that you would have got. Right? Which figure are we talking about? The figure that you would have got when you would have add your net profit to your capital, then you minus your joins, you'd have got a figure. Then you're going to add that long-term liability to it. Now when you add the long-term liability to it, right, you're going to get a total. Now the total that you get below should equal the total that you have above. So what we're saying, if you see those two arrows there, what we're saying there, if the top part, those arrows equal to 100,000, at the bottom part, the total must also equal to 100,000. And there goes your balance sheet, right? So pretty much that is what the balance sheet will look like. All right, pretty much that is what the balance sheet will look like.